Hey traders, today we're diving into a powerful setup in smart money concepts, the power of 3. In this video, we'll break down exactly what the power of 3 is, how to spot it on your charts, and the key rules to help you execute high probability trades with this setup. Plus, we'll go through real chart examples to reinforce what you learn. If you're excited to sharpen your trading skills, hit that like button to show your support, and don't forget to subscribe for more valuable trading insights. Let's get into it. The power of 3 is a smart money trading pattern that segments price action into 3 key phases: consolidation, manipulation, and acceleration. In consolidation, smart money builds positions while price remains stable, moving within a horizontal range. The market appears directionless, but this phase sets the stage for the next major move. Manipulation is the phase where the market creates a false breakout to trigger liquidity grabs and stop hunts, shaking out retail traders. So the manipulation phase is a liquidity sweep that happens before the next major move. A liquidity sweep occurs when the price breaks below support and then swiftly returns to the consolidation range. This signals a false breakout engineered to trigger stop-loss orders and lure breakout sellers. Once smart money gathers enough liquidity, a rapid move in the opposite direction, known as the acceleration phase, typically follows. As smart money traders, we aim to enter during this acceleration phase to capitalize on the liquidity grab after stop losses are triggered. The acceleration phase is the major move that follows a liquidity sweep. After smart money triggers stop losses in a liquidity sweep, price rapidly moves in the opposite direction. As retail traders, we enter trades right after the liquidity sweep to ride this next big move, taking advantage of the momentum created by smart money's actions. The power of 3 consists of consolidation, manipulation, and acceleration. This is the blueprint for how smart money operates in the market. If you understand and apply this strategy correctly, you'll be able to catch significant moves and trade in sync with smart money. There are 2 types of power of 3 patterns. Bullish reversal pattern. The bullish reversal pattern consists of 3 phases: accumulation, manipulation, and markup. This pattern typically appears at the end of a downtrend. In the accumulation phase, smart money builds long positions while the market consolidates. After accumulation, the manipulation phase follows, where a liquidity sweep occurs. Price briefly breaks below support, trapping retail traders, before closing back inside the range. The final phase is the markup, a strong bullish move in the opposite direction. As retail traders, our goal is to enter at the beginning of this markup to catch the upward trend. Bearish reversal pattern. The bearish reversal pattern also has 3 phases: distribution, manipulation, and markdown. This pattern typically appears at the end of an uptrend. In the distribution phase, smart money gradually sells their positions while the market consolidates in a range. The manipulation phase follows, where price breaks above resistance, triggering stop losses and trapping breakout traders. However, price quickly closes back inside the range, signaling a liquidity sweep. The final phase is the markdown, a strong bearish move. As retail traders, we aim to enter at the start of this markdown to profit from the downward trend. Understanding these phases helps us align with smart money and capitalize on these significant market moves. So now let's learn how to trade the bullish and bearish power of 3 patterns. If the market is trending up, smart money will eventually take profit. Wait for the distribution phase where smart money is taking profit. Once a range forms, wait for a liquidity sweep, also known as the manipulation phase. After the liquidity sweep, enter at the close of the candle that returns inside the range. Set your stop loss above the recent high. Your target is the next key level. This way, you'll ride the acceleration phase, which is a markdown. If the market is trending down, smart money will look for a good area to buy. Wait for the accumulation phase where smart money is preparing to buy. Once a range forms, wait for a liquidity sweep, also known as the manipulation phase. After the liquidity sweep, enter at the close of the candle that returns inside the range. Set your stop loss below the recent low. Your target is the next key level. This way, you'll ride the acceleration phase, which is a markup. Alright, now let's dive into a real chart example. As you can see, the market is trending upwards, meaning buyers are in control. At this point, the market starts to range, signaling that it might either break out and continue going up, or reverse and go down. As smart money traders, our strategy is to wait for a breakout above the resistance level, followed by a close back inside the range. Look closely, the market breaks above the resistance level, and then closes back inside the range. This is a clear liquidity sweep. What we're seeing here is the classic setup of distribution, manipulation, and markdown, a textbook bearish power of 3 pattern. After the liquidity sweep, here's how to trade it. Enter at the close of the candle that closes back inside the range. Set your stop loss just above the candle that made the breakout. Aim for the next support level as your target. Now, look at what happens next. The market moves down sharply. This downward move is the markdown phase, the final phase of the bearish power of 3. By understanding how to spot and trade the power of 3, you can clearly identify where smart money manipulates the market and positions for a downward move. However, keep in mind that the power of 3 pattern doesn't occur every time. Sometimes, after the breakout, the market might continue upwards instead of reversing. The key is to wait for a liquidity sweep after the breakout. If it happens, that's great. Take the trade. If it doesn't, don't assume the power of 3 strategy is ineffective. It works, but like any setup, it won't appear in every scenario. Now, let's look at another chart example. Here, the market is clearly trending downwards, meaning sellers are in control. Then, the market enters a range. As a smart money trader, this signals that sellers are losing control and smart money is preparing for an upward move. Watch what happens next. The market breaks below the support level but then closes back inside the range. This is a clear liquidity sweep. As a smart money trader, you recognize this as a classic bullish power of 3 pattern. You can now see the 3 phases: accumulation, manipulation, and the potential for a markup, which is the acceleration phase. Here's how to trade it. Enter at the close of the candle that closes back inside the range. Set your stop loss just below the candle that made the breakout. Your target is the next key resistance level. Look at what happens next. The market moves upwards just as expected. Alright, what if you spot a power of 3 pattern but miss the initial trade entry? Here's what you should do. When the market trends downward and enters a consolidation phase, watch for a break below the support level, followed by a close back inside the range, a classic liquidity sweep. If you missed the first entry, don't worry, wait for a pullback. The market often returns to retest the resistance level before continuing upwards. Place your trade at the close of the pullback candle, set a stop loss below it, and aim for the next key level as your target. As you can see on this chart, the market moves up, confirming a winning trade with a great risk to reward ratio. Now, let's look at another example.